show, and you just give us the information you think is pertinent to the group.
You know,
I've talked to quite a few people who called in,
mhm.
and everybody is kind of on pins and needles about the whole loan process. So if you can give them just a little bit of insight on, the steps involved or the challenges you see or how
Yeah,
you remediate issues, that would be helpful to my
yeah,
client.
sure. The most important thing is really basic. It's getting to the basics and sticking with them. And it's all about preparation when you come in. Part of that preparation is knowing what the lender is going to need, and what they're going to ask you for. So, very simple documentation wise, the lender is going to request that you complete an application. And typically, more times than not now, things are done online. So you are more than likely going to receive a request, an application to be completed online. And that's basically the direction that most lenders have gone in. Once
We have
the,
to mute someone.
sure,
Mm,
once the application piece is completed, you're also going to be providing documentation to support your application. So we're going to be asking for income documentation. We're going to pull credit. We're going to ask for asset documentation. So to know where your cash to close is coming from.
And
And
asset meaning your
asset, yes, your bank statements. It could be 401k statements. It could be stocks. We're basically looking to determine where your portion of cash to close for down payment, and closing costs, where that's going to be coming from. That has to be sourced. Okay. We'll get a little bit more granular in that, but I want to make sure that, again, we're clear on what documentation you're going to need to gather to present to the lender. Okay. So, again, your income documentation would include pay stubs covering the last 30-day period, um, typically 2 years worth of federal tax returns, so your 1040s. You also are going to need to provide your supporting W-2s that support your income and the federal filings, the tax returns. Basically, it's it's connecting the dots always for the lender. It's follow the money, right? When we're verifying different aspects of your paperwork. So we need to connect your paycheck stubs with your W-2s and then also with your federal filings to make sure the information is consistent with what you're reporting. Okay. So income is a big piece. The other piece, again, assets. So bank statements you're going to need to provide. And again, if your cash to close, what your contribution is going to be is going to come from a checking or savings or even a retirement account, or you'll be liquidating stocks, we'll need to have a consistent 60-day history, which is your 2 months. Okay. Um, One of the things that we are going to do is if we see any inconsistencies in deposits, like large deposits, we're going to ask, where is this money coming from? If these deposits are non-payroll deposits specifically, okay? We want to make sure you're not taking out a loan or creating a situation for yourself that might be a problem to qualify for the mortgage,
okay.
okay? I don't know if you're speaking, Kathleen. I can't hear you.
No, I'm just listening like everybody else.
Yeah, no, no worries, no worries. So that's our income and our assets. Another question that comes up, and one thing that the lender is definitely going to be doing is pulling credit. Okay. So your credit scores are critical. We are going to pull from all three bureaus, and they're going to be analyzing your credit scores. The magic numbers, let me just give them to you today. The range of credit that will qualify you is going to be anywhere from 620 up, okay? For conventional FHA financing, VA, all of the products, but 620 would be the minimum today in this environment. that a lender really is going to be utilizing to determine eligibility. Depending on where your credit score falls also can also play a role for the lender in helping assess which program might be best for you. So they'll be able to present you with different options. The credit, though, I want to explain to people. I've had people call me and say, Kim, my credit score is, 700 or 720, 740. And then I pull credit and it's not quite there. And they're not really sure what's happened. So, what I am going to stress is that what you have to remember about the credit piece is that when you see your own credit on through Credit Karma or through whatever um, program you might use to pull your credit, you're not applying for credit. And because you're not applying for credit, you're just seeing what a quick snapshot of what your credit is as today. If you come to me, I'm working for Bay Equity, I'm a lender, we're looking to extend credit. So when I pull your credit, there are going to be different variables and factors taken into consideration. So my credit scores that appear when I pull your credit may look very different than what you see when you pull the credit. Okay. I know those are questions that come up a lot. Why? And unfortunately, again, it's as simple as it's a quick snapshot that you're looking at. If you're not applying, your credit scores are great. Now, I have in some instances had pull credit for clients and it was right on the money from what they saw.
Okay.
So that's really been great. One other question that comes up a lot about credit is, I don't have a lot of credit, or how do I get my credit scores higher? What can I do? These are some of the challenges clients run into sometimes, is maybe their credit scores aren't high enough where they would like them to be, so that they can maybe get a better rate, okay, or have more flexibility with products that are available. So depending on what that scenario is, and every person's is unique, their credit situation is very different. Everybody's life is different. So we all experience different things. So drilling down on what could potentially help increase the credit, the most important thing is if you have revolving accounts, credit cards that have balances on them, you want to keep them at no more than 30% of the limit. If you're carrying a balance, the balance should be no more than 30% of the
Okay.
credit
So,
limit.
so let's talk about that.
Okay.
And so if you have a balance of, let's say, $1,000, your credit, not, is it the balance or is it the approved credit limit?
So when we're talking about the sweet spot, right, that's going to help improve your credit score, your balance on your card should never be more than 30% of the overall limit that is
Okay.
available on that card.
So if you have a credit card with a limit, say, woohoo, I have $1,000 limit on this credit card. I'm going to just go charge it up, right? Go out to dinner every day or what have you. Your balance, your actual balance, not your credit limit, your actual balance shouldn't exceed like 350. That 30% of 1,000 is three something, 33,
Yeah,
30.
300, let's say 300.
Let's say 300. So
Okay.
you should not be carrying a balance more than 300.
That is
Or else
correct.
it becomes a negative.
That is correct. It will negatively impact you.
And even if you're paying on time every month, you say, I never missed a payment or what have you, but you're carrying, say, 500 on $1,000 limit. So that's 50% of the
That's
limit.
correct.
That's a
That's
problem.
correct. So there are all of these charts that the credit agencies, when they're determining the type of credit you have, revolving credit tends to be the most volatile that will help your credit scores move up or down very quickly. And so, what we call the sweet spot to help you maintain a higher credit score is when you manage that balance versus the limit. And so, that balance should not exceed 30%. If you could keep it even under 30%, that is even better. I am a huge proponent of utilizing credit because it's necessary, because credit scores are pulled by employers by all different aspects. But keeping a balance on your credit card is not necessary if you can afford to pay it off. Pay it off. The utilization of that card is going to help. Okay? Even if you use it and pay it off at the end of the month. When you're carrying a balance on your card, and if you have to carry a balance, that's fine. The key is do not try your best not to exceed that 30% because that will definitely impact the scoring on your credit. And if by chance you come to me and I'm looking and I'm like, okay, I see your credit, your revolving accounts are at a certain level. I have the ability to look at a simulator and say, if we pay it down a little bit, and maybe we're waiting through the next cycle for it to report, we could see a potential bump in the credit scores. So the challenge that I've had with a lot of clients is they will come to me. One, they're not realizing that, I thought my score was much higher. And then when I pull it, it's not as high. So they're like, okay, what do I need to do? Because maybe they have some balances. I can come in and say, let's look at these, focus on these particular credit cards, pay them down, and then we can recycle or do what's called a rapid rescore to get the score back up. Okay.
That's great information. Wonderful.
Yeah. So credit, there was a question that we were just addressing also. A lot of things have happened in people's lives where your credit may have been affected, where you may have had collection accounts or, even bankruptcies or things in the past. And it's still possible to get financing. It does not negate you from getting a home loan. It's all about timing and it's all about how long, the seasoning of when did this happen? Okay. And have you reestablished anything since that happened? And have things been paid as agreed on time? Okay. Kathleen, we were just talking about a client who was asking specifically about collection accounts. And, the question was, is it necessary for me to pay off collection accounts?
Well, it
Because I'm
wasn't a question.
understanding
It was harassing me. It was so unfair. So he told me that
really nice.
fair. Like, why do I have to go through this? So I was telling him, what we needed to do and referring him to a lender. The lender told him that, the credit score was too low. And so, we're having this conversation. I just want to share with everyone. And I said, well, have you paid off? He said, I had all these old accounts. I've been paying off these old accounts and I only have 3 left. And I said, you have 3 left of what? I was like, what? And he says, I have 3 that are old and haven't been paid. And I said, you can't get a home loan with a collection account. And he says he was really incensed by the whole thing. And I was kind of surprised and I was a little hurt because I'm trying to help people get into homes. Like, I'm not trying to fight you about your credit. I'm one of the good guys. We're trying to get you there.
Yeah.
And he said that everybody is telling him that he doesn't have to pay a collection account. And I said, that's not been my experience. Mm-hmm. So I want you just, if you could briefly explain that you and I talked about medical versus non-medical. So if you can just take a moment, we'll just put it right here and deal with this. And I don't want anybody else to harass me about this credit.
Yeah. So been in the business for 30 years. I have personally experienced things with credit. And I know how challenging it can be to have collection accounts on your credit. Okay. But I will tell you that from a lending standpoint, if those collection accounts are non-medical related, they must be satisfied. And
Non-medical meaning credit
not
cards or installment.
hospital bill, a dental bill, anything that is related to your medical situation, if it's a collection account from a hospital, um, or a dental office, things like that. And even a dental office in some cases may be called out, but specifically medically related. And then there is a threshold for that. As long as that liability or that expense, that collection account does not exceed $2,500,
Okay,
right?
wait, let's go back. So I think we missed some. So we're talking, let's either talk about non-credit, like credit
Mhm.
cards, or, I mean, non-medical or medical. So first, whichever you want to discuss,
Yes.
non-medical or medical, go through that first. So we're all clear, we're talking about the same thing.
Right. So any collection account that is a non-medical collection account has to be paid. Period.
Period.
Yeah. Period. End of story. And, you know, if it's medical related, the beautiful part of this, if it is satisfied, the medical collection agency or whatever, if it's the hospital directly, they will remove that from your credit report. So, when you're weighing what makes most sense, if you're trying to buy a house, period, and you have collection accounts, and those collection accounts are non-medical collection accounts, you're going to have to make arrangements to settle that account or pay them in full. Okay. And it does not, the only time it will start to improve your credit score is once you have made that determination and paid it, so that the seasoning of that can start getting old, right? And that will help build the credit score again, but it will not rebuild. And, the challenge is people think it's going to fall off after a certain period of time. It's just going to fall off. And in some cases, I've seen that happen with regular revolving credit cards. However, those credit cards can be sold. The credit accounts, when they turn into collections, they can be sold to different companies. And you just don't know if something is going to pop up and rear its head where you think it may have fallen off.
Right.
So be careful in trusting that theory that it's just going to fall off.
So if I, in fact, had non-medical debt and
Correct.
medical debt,
Mm-hmm.
right?
Mm-hmm.
Would it be then more advantageous? So it all has to be paid off, is what I hear you saying. But on the on the medical,
Mm-hmm.
right?
Mm-hmm.
Um, does it have to be satisfied? You use the word satisfied. So I wasn't sure
Right.
if you meant that that has to be paid off, or if you can make arrangements with the hospital, because once that's paid, that's going to go away. You can get that off.
Right.
The
So,
revolve, it could stay.
right. So your medical liabilities threshold 2,500, right? Anything under $2,500 does
Huh.
not necessarily have to be paid off.
Okay.
If
So
it's
if I'm in
medical,
a situation and I'm evaluating, I have 2 grand, I could put it all on the
yes,
non-medical stuff that's more important to take care of the revolving credit and what have you, and pay that off
yes,
before we pay off the
yes,
medical.
because it's not a requirement of the lender to pay medical as long as we're below $2,500.
Good to know, Kim. That's great
Okay.
information. Okay. Yeah.
The key is, again, how is it going to help you with the credit scoring? And again, your lender has the ability, we have these tools that we use. So we can kind of gauge, does it make sense to pay this one off? Or, if I pay it off through the transaction or before, that's another big piece of this, because in some cases, when you pay off a collection account, that date of the collection refreshes. So it could negatively impact you. So what I tell clients, all the time is if we're going to be paying off collection accounts that have not already been paid in season, we're going to do it through the transaction so that we don't have any impact on the credit score. Okay. So I don't want to confuse the
Yeah.
issue.
Yeah. Okay. So
So we're,
we won't go too much deeper in this, but I
yeah.
think it's good for people to hear a little bit. We don't have to be experts, but
Yeah.
we just have to have a little bit of knowledge to help ourselves. So
So,
if there's a collection account, let me get this out of my head.
sure.
If a collection account that is affecting your credit and you decide to pay it off in the transaction so it won't start growing heads and what have you, how
Yes.
does that help you if it's already affecting your credit score?
We're going to run it through the simulator to
Okay.
determine should it be paid off now and will that help the score go up?
Okay.
If it doesn't help the score go up, we're going to pay it through escrow.
Okay.
Okay. We'll just get a statement and pay it off.
Okay.
The
I didn't
whole,
think it was possible.
yeah,
That's great. Okay.
yeah.
I'm done interrupting your
No worries, no worries. So,
uh,
but it's a big deal, right? And everybody's situation is a little bit different, so that's going to be important to drill down on. And it's important for you to know where you stand. So please go out to the resources and pull your credit before you meet with a lender.
so when you say pull your credit, are you telling folks like Credit Karma?
I am. I
Uh,
am. It doesn't have to be a hard pull. You just want to know where you stand. You know, you want to get some sense of where your credit is at the time when you're meeting with them.
Okay.
So that's going to be a question that they ask typically.
That's perfect. So you answered my big questions after I got beat down by my prospect. I was trying to help buy a house. Oh my God. That's really excellent information. So is there anything else you want to, we have a few minutes left in our half hour. It goes so quickly.
Um,
Any place else you want to go with this for the audience? And then we're gonna
no,
we're
I
gonna
just,
open it up to question and answers. So
yeah,
you can send us a question in the chat room. And is there another way they can, or
Yeah, they can also direct the speaker.
okay, and I think we're gonna open it up for questions, but let Kim finish this part right now. If there's anything else
sure.
you want to give us.
I do. I wanted to give you a little nugget here. We kind of touched on assets, right? And assets are your bank statements. So we know we need to have a 2-month consecutive cycle of documentation. The lender is going to look at your bank statements to see if there are any large deposits to determine whether or not where that money's coming from. Okay, we're going to always follow the money. So I wanted to bring that up because a lot of people come to me and are like, I don't have a lot of money. So there are programs that are available to first-time buyers that are out there. There's money out there, and people work with the CalHFA program, which is the California Housing Finance Agency. They offer down payment assistance, and their income levels are high. There are limits, but they're higher. So that is something to explore. That program that's offered for your down payment and will cover a portion of the closing cost as well. That has to be repaid. So it's a program that's out there. There's another program that helps with down payment assistance, which is GSFA, and that's Golden State Finance Agency. That's another really great program. Both of those products work with conventional FHA and VA financing. So it's layered with that. But they give down payment assistance. We just have to make sure you meet the eligibility requirements.
I've used both of them, and they're great. I mean, it helps you with your money. Now I want people to know you still have to have some savings.
Mhm.
You should
Yes.
focus on that. If you're not paying off your credit cards, you have to kind of prioritize your life. Is it more important to save money for a down payment, or is it more important to pay off credit cards that may adversely affect you? So have a strategy in mind. And then you can always talk to Kim, who's just like wonderful. You can see, and she can help you. And so maybe we don't have it all together today, I tell people you cannot wake up this morning and buy a house this evening. That's not going to happen, right? But you can plan and you can prepare and you can know what you have to do to get in the market. And so I'm really delighted that you're here and able to give us just a little bit. This is not, you know, a 3-hour seminar. It's to just give you some basic information. If you're interested in contacting Kim directly, we will put her information up here for you, but you can give them your contact information right now, Kim, and everybody can write it down. Do you have your pen ready, people? Right? Ready. Okay.
So my email address first is the letter K, my last name Silverman, and it's at bayeq.com.
Okay,
So
we're going to post it too.
perfect. K Silverman at bayeq.com. My direct contact is 510-812-2411.
Got it. Twy, my right-hand person, is getting it up on the screen pretty soon. So everyone, it'll be there in a minute. I think that's what he tells me. I am just not the expert. So do we have questions? Anyone? Let's see. Let's see if we have any questions here. Okay, he just got it up. Twy, would I see any questions? I don't see any questions. Can we?
We can turn on the mic.
Okay, we're gonna unmute you all. So if anyone has a question for Kim, you can ask her now. Give us one moment to unmute. It's gonna get a little noisy once we unmute people, so just bear with us. I see Sandra. Hi, Sandra.
Hi,
How are you?
I'm good. I'm trying to type this question up here for Kimberly.
So now you don't have to type. We got you. Carol.
Okay, great. I wanted to reflect back on the collections account. I'm in a situation myself where there's been a collection placed on my account. I'm just trying to figure out, I don't know what to do. I have some people working on it, and then I have an appointment with Hera as well coming up on the 30th. I pretty much have a immaculate credit, but as soon as when last year when they did this, when we had the election on the bail bondsman situation and it didn't pass, then I looked around and they had put this this bill on my account, which is not mine. It belongs to a family member of mine. However, it did hurt me, but then I guess I don't know, you know, my score is pretty high, but I want to get this off of me. I want it off.
Do you know what your score is now, Sandra?
Pardon me?
Do you know, you said your score is really high. Do you know what it is now?
Yeah, it's 784. Hold on a second. 784, 744. And that's the only two I got. Those are just one moment. Let me see.
So she has an unusual situation, and I referred
Yes,
her.
it's very unusual because for me, my situation you can't just look at my situation and say, wow, well, is this ladies or is it not? Because my history won't add up to it. Do you understand what I'm saying?
Absolutely.
So it's just like I got to figure out what to do about it, because yeah, 787, 744, TransUnion 744, Equifax 787. The FICO score is high too. I forgot what the mayor said it was, but
okay.
I mean, I have like
question.
I don't know. I want to know how. Do I have to pay that? Because I have a goal I'm trying to reach.
So Sandra,
this collection is $6,000.
Okay, Sandra, we're gonna mute you so we can hear Kimberly.
Yeah. So there are different types of collections that appear on credit, and depending on the type of collection it is, for instance, if it's a tax collection,
Mhm.
if it's a specific type of collection that could take precedent over the first mortgage, the lender's going to say it has to be resolved, meaning it has to be off of your credit. Even though you may be perfect, even though your credit history may be perfect, when they see that credit or collection on there, if that hasn't a chance to go before the first mortgage, if you're buying a home, then that is going to have to be satisfied. So let me backstep a little bit here and say, if that liability or that collection does not belong to you and you did not co-sign for anything, there has to be a paper trail, proof of paper. There has to be something before a collection can just be added onto you or placed on you. So if that is truly not your collection, or you didn't co-sign for anyone, to get that, you're going to need to have some proof. You're going to need proof to get it removed, right? That it did not belong to you.
Yeah, so I did talk to her about this, and so she's gonna talk to some attorneys because she needs a little bit more legal advice on how to manage this.
What-
And Sandra, we've talked
Can I,
about
s-
it before.
can I say something right quick?
And
I'm not,
really quick, Sandra, because
okay, really quick. I'm not disputing. It's not my, it was not for me. I did co-sign, I'm not gonna lie about that. But I mean, so I don't know.
So Sandra, let me clarify here something really quick. I'm not sure then if you were clear when you co-signed what responsibility you were taking on by doing that. Because what that says is, in the event that if the person who is obligated to that, you are going to take up a portion of that in case that person does not perform. So if that person does not perform, then guess who it falls back on? You, because you have co-signed. So now it becomes your responsibility, your obligation, even though it's not yours, you were helping someone out. And you have to be very careful with that, because unfortunately, it creates situations like this. So,
okay.
I
But
wish you luck with
yeah,
that.
she's I've given her some resources, so hopefully that will help you, Sandra, and we'll be talking again soon.
Okay.
It.
Okay.
Does anybody else have any questions, or are all these people muted, or what's going on?
Hi, my name's Dominique, and I have two questions. I'm still kind of fuzzy about like how much I need to save or like put down towards a payment towards a house. And then also my second question is if I have like maybe $50,000 in like student loans, but I'm paying everything on time. I've never been late, paying a little more when I can. Would that put a damper on me getting a home as well?
So, with all of the programs, or any time you qualify to purchase a home, a lender is going to look at your overall debt to income ratio, right? So, as far as your student loans are concerned, they will be calculated as part of the debt to income ratio. We didn't cover that at all. So the sweet spot again, for a lender is at 45% capped, right? And we're basing this on your gross earnings. So before any taxes are deducted, any expenses are deducted, what we're going to say is, what is 45% of your gross monthly amount? And that has to cover the new housing payment, which will include what we call PITI, principal, interest, taxes, and insurance. Plus, it has to include your overall liabilities that show up on your credit report. Okay. So when we're looking at this, if you meet that 45% debt to income ratio, which is set up by the investor guidelines for qualifying, that is the sweet spot. In some cases, we can go over that a little bit. Yeah. So everybody's situation is going to be a little bit different. We just have to see how close you are to that debt to income ratio with the student loans.
So I need my calculator, but as an example, if your income is $1,000 a month, 1,000 makes it easier for me. Your expenses, the mortgage, which includes the principal payment, the interest, the taxes, property taxes, and insurance cannot exceed 45% of your income. 45% of $1,000 is $450.
Correct.
So I'm just giving you a measure so you understand. So if you make $3,000, just apply 45% and know that the housing payment and all your debts has to not exceed 450. If we use 1,000, I can't
Right.
use, I'm not that math wizard. Okay, so does that help you? Does that help you at all? I'd have loved
Yes.
it.
And then with the other question, as far as like how much I should be saving, as well as how much I'm not.
For down payment, you were
Yeah.
asking? Yeah. So to be clear, there are programs that allow you to put as little as 3% down as a down payment. Okay. And again, there are those programs that assist with down payment assistance. But I would encourage anyone to save as much as possible. When someone comes to me and they're saying, how much should I save? I think, personally, it's really going to be dependent on your price point that you're looking to purchase in. But you always want to have at minimum $5,000 to $10,000 because you're going to have other expenses outside of the loan also that have to do with inspection, things of that, and you're going to have to spend some other money that's not related to the loan. But if you're not qualifying for down payment assistance, traditionally you're going to need to put at least 3 to 3.5% of a sales price or a purchase price as your down payment. And you can do that calculation. If the property you're looking at, is 400,000 or 500,000 or 600,000, depending on where you're looking, you're going to need to put 3% if you're doing a conventional loan or 3.5%. So if you do that calculation, you'll get a gauge of how much you would need to have in savings or 401k, stocks if you need to liquidate in order to have a down payment if you're not eligible for a down payment assistance program. Does that help?
Well, the other thing I'd like to say is that you do need 3% generally for down payment, but you also need that much again frequently for closing costs. And so this is something that people don't always talk about, or if they have a conversation, they'll say it in one word, down payment and closing costs. Like it's all the same thing. It's really not the same thing. But you need to know approximately how much. So I would say between the two, it's 6%, minimally of the sales price. So if the sales price is 300,000, which there's nothing in Oakland for 300,000 right now, and or San Francisco, and you add 6% to that, that's $18,000. Does that help? And if you do a down payment assistance, that will cut into that.
Right.
The down payment assistance can help you significantly with that if you qualify. And that's why I'm encouraging everyone to consider down payment assistance, because you may take it from 18,000 to 7,000 with down payment assistance. That's huge. So we've got to go there and we've got to fight through it and use down payment assistance program. And Kimberly is approved with the state and everybody else to do that. Not all lenders are approved to use the down payment assistance program. So that's why I have her on here today. We really want to utilize down payment assistance.
Okay, thank you so much. And is it possible you can write the assistance programs that you said earlier in the chat?
Sure.
Yeah, absolutely. I'll give those to you.
Um, I'll have to look that up. So how about if we send it to you when we send you a copy of this webinar after?
That
it's-
sounds good. Thank
Okay.
you.
Thank you. Any other questions?
Yes.
Yes, hello.
Hi.
Hi, this is Barbara. And I was wondering if you guys were checking the chat box because I didn't really want to talk. I'm just listening and kind of taking notes. But I did send a message inside of the
You
chat
want me to
box.
read? I'll read your question unless you guys can see it. I really
Yeah,
don't know.
you can read it. I'm fine with it.
Okay, it says, is it possible to be on disability, have good credit, but not qualify because of fixed income? Does that mean I can never own a home? Or is there any first-time homeowner programs I may qualify for? So I would say no. If you're, are we talking about short-term or long-term disability?
Long term.
Okay.
So permanent, that's permanent income.
It's permanent income. Absolutely. We qualify people with that all the time. So
Oh.
it really depends on what the level of the income is. And
Okay.
again, what you're purchasing. Yeah. How much you can afford based on your income level.
Okay. Thank you very much.
You would definitely, hopefully qualify for down payment assistance and move you in. So talk to Kim and talk to me. We'll try and work it out.
Absolutely. Thank you.
Okay, we have another question in the chat. Thank you for reminding me to look in the chat. From
Question.
Davinia,
I got a question.
who's speaking?
Sandra.
Oh, Chandra,
Are you-
yes.
Yes, I just wanted to re-clarify. You guys are gonna send copies of what to us?
I'm going to send out this webinar, the
Uh-huh.
entire webinar.
Okay.
So it will have all the information. We will also send out the 2 down payment assistance programs, the information,
Mhm.
and you can look at their websites. But quite frankly, I got to tell you, you might want to work with a lender. It's a little confusing to try and figure out those down payment assistance programs on your own. But certainly we'll send you the links. And we'll send you the link to this webinar, which
Well,
will,
are these programs with the down payment system, do we have to pay this money back?
It
Oh,
depends on the program you utilize. Yeah. So we
But
could
there
go,
are programs that help you that you don't have to pay money back. Is that correct?
that is
Yeah.
correct.
But those are the ones that I would be more interested in. And then what is the difference? What's with the FHA loan? I mean, is this a program as well as a loan program or what? I don't, someone said that, that you should apply for that.
okay. So depending on what you apply for with
Uh-huh.
the state financing, they have different types of loan programs. Some of them require repayment and some of them don't. So you can go to the websites and look at that, or you can talk to the loan officers about which program is appropriate for you. You said you don't want to repay, then you go with the program that you don't have to repay. Sometimes those the interest rates are a little bit higher on those programs. Some of the requirements are a little bit more stringent.
Well, why would is that just because of that you don't have to pay back? You said it's a little bit more because everybody I've ever talked to make it seem like it's so easy. You first time homeowner, you apply for this or they got this and that, just and then
Yeah, it's not. So let me just say something here. Buying a home is not easy, period. End of story. Getting the financing together, if people tell you, oh, it's so easy, I don't know who's told you that. Anybody who's recently tried to buy a house is not saying how easy it is. It's a challenge on every level. Just finding the
Yes.
getting the financing, getting an owner to accept your bid when there's 20 other offers, and then having a realtor and a loan officer who are experienced in this. Because let me tell you, when you go to write an offer, and you have down payment assistance, and another offer is competing with you and they don't have down payment assistance and they're putting down 20%, the owners are going to go with the
They're
easiest.
gonna go with them. Yeah, I understand.
Unless you have an agent and loan officer to help them understand. There's a lot of agents out there that don't understand it themselves, let alone trying to explain it to itself.
So quick question.
So
Say you got down, say you got money to put down and you still want assistance and you're a first time home buyer. Is that possible?
yes,
Absolutely. Yeah.
See, I mean, I understand you got to pay to play, but if you got money to put down, say maybe you got 3%, maybe you got more than that, and you still want to get some assistance, being this your first time, it's like, this is scary, you want to, and you don't know who to trust. I don't know who to trust. It's like,
we're telling you that the more cash you have down payment is good. Your down payment has no effect on whether or not you're eligible for down payment assistance. Zero
Mhm.
effect. What does have an effect on it, and I'm going to give it to Kim because I'm in her
That's okay.
is that your income. So if you're making over $108,000 a year, you may not be eligible to participate in the down payment assistance program. Why? Because they don't want people with $100,000, $150,000, $200,000 income getting assistance from the state.
well, I don't think any of us will qualify for that. Not
We want to save it for people that need the help.
right, and that would be low income people. Is that correct? I mean, none of us here makes those kind of figures. So the assistance would be for people like in my position, wouldn't it?
So they have limits. So I'm not going to try and quote the limits, but it's just somewhere around 109,000. It doesn't matter if you fall into the category that you're eligible. No, please say you're not going to, you don't deserve to get it. So if it's 108, is it 108 or 109, Kim, or is it more? No, something.
Yeah. It's 104.
So yeah, so it's there for you. We're not fighting you. We're telling you. Okay, we're saying yes. Come on, let's do it.
Yeah.
Like, you guys got the information, so you're sending it to us, right?
We'll send it. Do you see? Did you? We put up Kim's information, I think, in the chat.
Yeah, I see it.
We'll put up more, okay?
Okay, let me look in the
Okay,
chat.
thank you.
Any other questions? You're welcome. Any other questions?
Yes, this is Yvonne, and I do have a question going back to the credit.
Sure.
I have one that I am currently disputing, but I'm
Okay.
already at the process where I'm ready to start with the agent and the broker. And as you're saying, I should not pay that off. I should wait till it goes to escrow, or am I understanding that correctly?
Yeah, so let me clarify. When your credit is pulled, and if you are already disputing this item on your credit report, the first thing your lender is going to say to you is that the dispute has to go away. You have to get it out of dispute because they will not move forward with it being in dispute. Okay. So if your plan is to pay it off, then what I'm saying is if you're not trying to improve your credit score, you don't need to improve your credit score, and it's just a collection that has to be satisfied, and you're in the process, disputes don't work. So you'd have to take it out of dispute. And I would suggest if you're not trying to improve your credit score, pay it through escrow. You don't need to pay it in advance.
Okay, so I should continue with the process of signing the paperwork, filling everything out, submitting it, and then the oh God, I can't think right now. Then the mortgage company lets me know the next step.
That is correct.
Yeah.
Okay. Okay, great. Thank you.
Yeah,
Great.
they need to take a look at it and then they're going to advise you. And I'm big on trusting your advisors. I mean, I don't want you guys trusting any Yahoo out there. But for those of us who have been in the business 30 plus years, you can rely on the fact that we're still around, that we kind of know what we're talking about. And our goal is to help you get into the house. So remember, rely on us heavily and not all this stuff. I've heard so much stuff out there. I didn't even know about this group called, I think it's Lexington Law.
Lexington
Oh my-
Law.
I just found out about these people. They're everywhere. And I don't know that they're giving the best advice out there. So be careful of who you are trusting.
I got a question right quick for Ms. Silverman. Did I hear you say that it's possible to pay the or either to have the collection part? You can pay it through escrow. Is that what you're saying?
That is exactly.
Because I'm trying to, if I could get someone to, I don't know, maybe if I could get an attorney to negotiate this here price to be that's beyond my reach. But if they could negotiate the price and then maybe if I could pay it through there, I could
Yes,
pay.
yes.
You know,
Okay.
so that might be a really excellent alternative for you, since you're saying your credit scores are in the 700s. So
Right.
so there's no reason for you to push any further, but maybe let it be paid off in escrow once you've done the house. I would definitely talk to Hera about it, helping you long term,
Mhm.
and then you can talk to him and other folks. But remember, you also have to have the income to go forward.
Question.
Yes, I know. I'm
A
already, yes. Mhm.
May I say something?
Okay.
Who's
Hi,
speaking?
this is Barbara again. I know I'm running out of time, so I'll try to be fast. But I'm thinking about when you say how does charge-offs affect your ability or the possibility of home ownership when you're looking at the credit and stuff, and if you have charge-offs?
If you have a charge off that still shows a balance, the lender is going to question you about that. And typically it's going to fall in line with collections.
Hmm. Mm-hmm.
So what you want to do is, even though the creditor may have charged it off their books,
Mm-hmm.
saying that account is still owed, that account still has a balance owed on it.
Oh,
They've
so it's open.
written it off their books, but if there's a balance showing up on your credit report, there could potentially be a balance that is still owed. So a lender is going to look at that and treat it the same way they would a collection. So if there's any derogatory credit that is related to collections, charge-offs, you're going to have to address those. And when I say address them, you need to find out if there's an open balance remaining.
Okay. And when
And
you
that
say
would be
derogatory, now I did look on my credit thing, and it says I have no derogatory um things on there, and my credit score is really decent. But you're saying no matter what my credit score are, they are gonna look at those charge-offs and add them up as far as what I owe.
If their balance is still on those accounts, yes, they could look at those and ask you to satisfy those. They'll ask you, what are they? So it's a little bit more complex. It's like a collection, because if the account is still reflecting a balance, there's something out there that's still there. Even doesn't matter the age. If it's
Right.
reflecting a balance,
It doesn't have a balance. They don't have balances, but they're charge-offs, and they don't have balances.
if
It
there
might,
are no
it might depend on when the lender pulls the credit.
right.
You know, you
Okay.
can look at it, but the mortgage credit is different than the consumer credit, so it
Mhm.
might be put differently. I don't know that you'll know until that happens.
Right.
Or I would suggest that you contact the collection agency. I know that's hard to do. I know
I
that's,
know. Okay, but I get it though. Thank you.
you're welcome. Okay, so are there any other questions? Because we're going to wrap it up. We put in the chat box, and we'll leave it up for a minute, the GSFA home.org. That's the Golden State Finance Agency. It's a down payment assistance program. And then the second one is the CalHAPA. And we put that up for you guys. So I'm done. I'm good. I'm going to send you guys a copy of this webinar. And I can't tell you how excited I am that you are calling in, trying to resolve these problems so you can move forward. We have a crisis in the African American community in terms of home ownership, and I am here to help you. I promise you, I'll do everything I can, but you have to do everything you can to move forward. This is a great first step, and Kim is great. I'm great, of course, but
You are great.
so thank you for
You
showing.
guys sure are.
Thank you for showing up today. We are going to have another webinar in March, the end of March, but it's for people that need to downsize, usually for people that have been in their homes for a long time and they want to move. And it's, you know, if you've been around your mom or your dad and they've lived there forever and ever, they have 50 years worth of stuff and somebody's got to deal with it. So we're going to have a organized pro come in and talk to us. So we'll send you guys all that information. And thank you so much for attending. It was great. And you guys have a great weekend and take care. Kim and I are signing off. Thank you. Bye-bye.
Thank you.
Thank you, ladies.
Bye-bye.
Thank you.
Bye.